Hello, everyone. Today on the final bar, we're going to talk about market recovery, I guess we will call it. It's hard to come up with verbs or adjectives to describe this evolution of the market. It's sort of feast or famine. You have a big down day, big up day, everything in between. The goal of this show is to focus on the long-term trends. The base case with stocks has been a pullback to support and testing support today. Nice rally off the lows from last week with the S&P closing at 33.85. We're going to hit the market from all directions, top down, bottom up, sectors in the middle. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com in a smoky Redmond, Washington. Thanks for joining us every weekday after the close to make sense of these markets together. As I mentioned in the introduction, we're in a period of heightened volatility, lots of movement. One day to the next can look very, very different. The best we can do is look at the long-term trends, look for themes, not just in one day, but in a sequence of days. And trends are made up of a series of days and weeks all sort of going together. And so let's look at some of the big picture markers. On Monday, what we do is hit the markets from a top-down macro perspective. What are the key big picture themes? And we're going to talk about stocks versus other asset classes. We're going to focus a little bit on the dollar, which is showing some signs of bottoming out. Let's see what that might mean for other things. Then we'll talk about sector rotation. We're going to look at the movement of the different sectors. As we've talked about last week, there's been certainly a rotation of sorts away from technology, away from a lot of the things that have gotten us to this point, into things like materials, industrials, elsewhere. And then in our bottom-up section, shifting stocks, we're going to focus on the scooter reports and look at some of the top-ranked names and how they've been faring. Now, we have a lot of fantastic guests on the show. It's one of my favorite parts is being able to have conversations with people that know a lot about a lot. And this week is no different. Tomorrow on the 15th, we have Dave Settle joining us from Market Scholars. On Wednesday, Pat Ceresna from the Market Huddle podcast. And then on Thursday, David Auerbach from the Daily REIT Beat. Be an interesting sort of a group of experts to help us think about what we're seeing. And the main question I hope to ask them is this a pause before further upside, or is this the beginning of something deeper? So we'll see what answers we get. Also, next week, we are putting the finishing touches on our September 22nd event called Introducing StockCharts ACP. We have had some wonderful conversations, guys like John Murphy, Martin Pring, Ralph Acampora, Larry Williams, Arthur Hill, Dave Landry, some fantastic strategists, all sort of giving us their take on technical analysis, how charting has evolved, but we are going to be focusing on the ACP platform, which is the latest development from StockCharts, how it relates to the rest of the StockCharts platform, just showing you a lot of really good examples of how you can analyze the markets more effectively using this new dynamic platform. So join us for that on September 22nd. Let's get to our market recap. So, and again, as a reminder, we're going to start with sort of a top-down view and talk about some of the big picture themes. So just in terms of what happened today, stocks finished strongly. They really opened out of the gates pretty big. And so most of the gains, if not all of them, came in the first hour. Since then, it sort of chopped around, leaned more negative than positive. So the big move was out of the open. After that, if you look at the movement since around 10:30 a.m. Eastern, overall directionally a little bit lower, but it had locked in a good amount of the gains. The S&P finishing above 3380. The NASDAQ actually leading away a little further, and technology was back to outperforming today, up over 2%. Mid caps and small caps all up and up more than the S&P. The VIX a little bit lower, trading just above or just below 26 with today's rally. In terms of other asset classes, then we'll look at some of the charts together. Bonds actually finished flat. If you look at the TLT, had a little spike going into the close of the day. 10-year yields off a little bit. Up a little bit with that. Commodities, you saw oil come off, but pretty much everything else for the most part was up, especially gold and silver, precious metals. We talked about that environment, gold pulling back to an increasing and ascending 50-day moving average and seeing if it's able to hold that. So what's interesting when you think about the big picture is that a lot of assets, a lot of different charts have all sort of gone through this similar evolution. a nice run into the first week of September, and then pulling back many of them to an ascending 50-day moving average. If you look at the S&P, that's our chart there. If we go quickly to the GLD, you'll see, again, different chart, but a similar pattern where it's pulling back to the 50-day moving average. So in general, all else being equal, what does that usually mean? In a longer term uptrend, you're going to have a series of pullbacks, and more often than not, in a healthy trend, the 50-day moving average or the 10-week moving average tends to be a pretty decent, pause. That tends to mean it's gotten a little bit away from the longer term trend. It comes back, a little mean reversion back to a swing low, and then it's able to rally a little further. Gold, you have the GLD sitting right around 180 and testing it a couple times, but never really following through. Hit the 50-day moving average last week, and now it's sort of trading just above there around 183. And the question is it able to break out of this pattern going higher, or have we hit a stop loss that we trigger and you have to start looking for lower lows? And I think a similar sort of thing is there with stocks. I think you've seen with both of these asset classes a pullback to the first line in the sand, the first level that you would expect. All right, if this is a longer term uptrend, this is a healthy uptrend, and this is just a garden variety pause, this is about where you'd expect it to hold before the next move higher. And you see with the S&P, we've had that similar move. We tested the ascending 50-day moving average on Friday, did not close below it. We closed back above it. And then today, as you know, we bounced a little bit further. So we, again, are still sort of testing this first level of support right around 33.50, 33.25. That's price support from mid-August, and also the 50-day moving average. If we would break that, the next tactical low or the next tactical support would be around 3,200, which is the low from late July, also the peak from early June. Pretty meaningful area there for stocks, and that's the level I would look at. If and when we would break that, that's when I think you have to start doing some evaluation about further downside, and especially not just with the broad market, but on particular positions, right? Thinking about long positions, and again, now is the time to be doing it. It's not when things have broken any more than this, to sort of identify if X, Y, Z would happen, what is that, and what would you do? What action would you take? And write those things down now, because as things start selling off, especially on a quick sell-off, is not when you want to start scrambling for stop loss levels. This is the time to do it when things are still holding up okay. So I think the question to be answered by stocks and by gold this week is whether we hold these recent levels and which of these find support, which of them break to further lows. Now let's rotate and talk about the dollar, because as I mentioned, the U.S. dollar, we've talked about a number of times. A number of my guests recently, a couple of weeks ago, really focused on this. And the challenge has been since the March market low, which was here, you can see that it's been a heavily weak dollar environment. Now, in general, what that means, I mean, if you look at long history and you sort of pay attention to what a weaker dollar tends to mean, it would tend to mean it's a headwind for U.S. stocks, especially relative to global names, and also you would expect small caps to be underperforming in a weaker dollar environment. Stronger dollar usually means stronger U.S. stocks and stronger small caps, and that's because the strength of the U.S. dollar means better environment for better sign of economic strength, better sign for U.S. stocks, and then also with small caps you have the issue of the average small cap stock doesn't have to deal with currency differential and paying people in other currencies, bringing in revenues in other currencies. A multinational will have to, and so they're sort of immune to dollar weakness as much as a large mega cap U.S. stock, which most likely is operating outside the U.S. What's interesting is if you look at March to now, it's not been a clear cut. The market has been, U.S. has been underperforming because the dollar's been weak. If you look at stocks versus bonds, if you look at U.S. stocks versus non-U.S. stocks, it's not just been a linear move from March to now. There have been periods during this period of dollar weakness when U.S. stocks have outperformed global, and other times when it's not been the case. So I would hesitate to say a stronger dollar means XYZ will happen, but it's good to know the general bias. It's good to know what that condition usually means and what tends to do well, and then focus on the charts themselves and see what's happening. The chart of the dollar speaks to strength here for me because we've come down a lot. If you look at this bear flag pattern, sort of midway on this run, if you take March to here and you project that downward, we're sort of near the point where that might be a logical objective if you think this was midway during the decline. But most importantly is the lower lows in price, the higher lows in the RSI, and I think that is more than anything suggesting a bit of short-term strength here. So, seeing the dollar go higher, seeing it established a more confirmed higher low, because we had this sort of swing low here, but not really on a closing basis. We're still sort of on this thrust out of the lows from the beginning of September. You'd like to see sort of a higher low to confirm that this pattern of lower lows and lower highs has reversed. And until then, the trend so far has remained relatively negative. That's our overall recap, again, focusing on some of the big picture macro themes. Let's go to our next segment called Sector Setup. So step 2 on a Monday is we've reviewed the big picture. We see stocks pulling back, gold pulling back, the dollar potentially bottoming, but we'll have to see it proven out on the charts. Let's look at the sectors and see what they've done. Now, I had some great feedback recently when I show the RRG. Time has compressed, so much in a lot of different ways in this market. And so we're going to start with the daily RRG. So we usually look at the weekly, which we're going to look at in a moment, but this just shows you the short-term rotation. I've had a lot of comments that I've heard, basically saying technology is weakening. That's fine. That's part of a leadership rotation. Look at industrials and materials are strengthening. I'll tell you why I don't think that's necessarily the case, but I will tell you how that rotation certainly has been happening in the short term. And the daily RRG is a great way to visualize that action. So here's tech, the XOK rotating down in a southwesterly direction, communication services XLC heading southwest as well. Pretty much everything else with the exclusion of energy, which is just the outlier down here in the lower left, which again, from a technical perspective, I think you'd be hard pressed to lean into energy at this point until you see some sort of outperformance, some sort of constructive chart patterns we have not seen yet. The trend is lower and has been that way for a little while, especially on a relative basis. But look at how everything else is heading northeast. And this is on the daily, right? So it's a little bit shorter term, but it's recognizing this short-term rotation away from the leadership of tech, of communication services, into things like materials, into things like industrials, consumer staples, financials, real estate, which was the number one out of the 11 S&P sectors today, even utilities. So these are the sectors that have started to improve on a relative basis, while the tech and communication services, really the leadership up until the last couple of weeks, have started to come off on a relative basis. Really interesting to see consumer discretionary, which has made a loop here in the weakening quadrant. And talking with Julius de Kempener for a long time about just ways to think about this methodology, how to use it. One of the things we've talked about is this sort of clockwise rotation that doesn't revolve around the entire display, which implies periods of outperformance and underperformance. If it's making a loop here on the right side of the zero line, that basically means it's outperforming consistently, and it's just a question of how the momentum is shifting. And that's where we see the XOY, which is why it's also a really key chart to be paying attention to on a relative basis. If you look at the chart of the XOY, which we'll look at in a minute, you'll see what I mean. Now, switching to the weekly RRG, we can see some of the longer patterns and why things like industrials and materials have, I think, emerging not just in recent weeks, but in an overall rotation. You can see the XLI here now in the leading quadrant over the last week. Materials had been heading south and actually rotated northeast again. Consumer discretionary heading northeast. So the three sectors in the leading quadrant and all heading in a constructive direction are industrials, materials, and consumer discretionary. And if you ask me for three sectors that look most attractive from a technical basis over that intermediate term, I think those are the three that I would probably look at. Technology is still very much a question mark, and I think the question mark that the markets have to answer, maybe three that I would look at besides the sectors we've talked about. Number one, does technology come back? Right, we had the mega cap tech names leading, screaming to the upside, all pulling back in a big way in recent weeks. The question is this the pause before we resume tech leadership and we move the XLK to new highs again? That's question number one that I don't think we can answer yet. Consumer staples has been an underperformer, but rotating in a more positive direction. Do sectors like consumer staples and financials, which have been essentially underperformers, but it's starting to improve a little bit? Do we see further emergence in those sectors that suggest there's opportunity there, and where we've sort of written them off mentally? And then the third one, maybe the third question mark, would be healthcare, which has been sort of a mixed bag. And when you think of charts like and some of the biotechs and others, they've all had, in the short term, certainly more distributive patterns than constructive. And the question is this, again, the beginning of further corrective movements? Do we have to think about downside objectives for something like Regeneron, or is this the time to accumulate before the next rise higher? So from a sector perspective, those are some of the questions that I would be looking at as you review each of those sectors. Well, let's hit on a couple of the individual charts. With consumer discretionary, we can see the relative performance that's just been solid. This bottomed out on a relative basis before the March low. It actually bottomed out the beginning of that third week in March, and since then has had this fantastic run of relative performance, making new relative highs last week again for the last year, last 2+ years. Continuing to move higher on a relative basis. We've sort of had this pullback, as most charts have, and again on a price basis, it's all about whether this pattern resolves to the upside or the downside. You have this short-term narrowing pattern of lower highs and higher lows, and that has to break one way or the other. I'd be very keen on recognizing which way we break from there in a consolidative period. You see which way the price breaks, and that's usually buyers or sellers taking control and pushing the price to new swing highs or new swing lows. And I think that's what you have to be looking for there. Going back to the sectors, financials we've talked about, and again, I think there's still a lot to be proven here. As we talked about last week, there's been a number of times where the XLF has attempted to get above its descending 200-day moving average. It's 3 for 3 and failing at that level if you look at the last 4 months. So I would want to see that break and actually hold, and then the follow through would be a break above 26, would take it above the Fibonacci level, which has also served as resistance. So you sort of have this cluster of levels, this confluence of resistance that you want to see the XLF get above. I would say on the individual chart basis, there are charts within financials that look more constructive than others. So certainly as a stock picker, I think there are opportunities within there, but it's really perhaps a time to dig through it and see what we can find. We talked about technology, and I think if there's one chart I would be looking at just to get a read on, do we recover from here or do we go further down? I wrote an article on this a couple of weeks ago. I'd encourage you to check that out, about a bull market top checklist. One of them was a general rotation away from offense into defense, and there are a number of ways we can do that. The XLK testing a trend line using the relative lows from June and July, I think, was one thing. It looked like we were just about breaking that. We've sort of paused at that moment, and it's right when the XLK pauses at its ascending 50-day moving average. As much as we can talk about leadership rotation, I think we've seen that. I think we've seen places like industrials and materials really start to perform well, and I see all the signs of that persisting. But my point that I sort of hinted at earlier is if the XLK breaks down on a relative basis, if the price does not hold at its 50-day moving average and rotates lower, and that means stocks like Apple and Microsoft and other big mega cap tech names are rolling over, I don't see that as a scenario where the market moves on to meaningful highs with those mega cap stocks dragging down the performance. There aren't enough FedExes and Freeport McMorans in the world to compensate for that theme rolling over, because I think that's where a lot of people have been sucked into this outperformance of technology and communication services. That's why I think it's such a crucial indicator, not just from a trend following perspective, but also from a psychological perspective. We see stocks like Apple struggle. If we see the XOK roll over, that's a different environment. I don't see that being a constructive, bullish, long-term environment. I see that being more pain before we can continue further. That's our segment on sectors, and we need to take a quick break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. I mentioned a smoky Redmond, Washington, and certainly we think good thoughts to everyone on the West Coast dealing with these weather issues with smoke pervading around the environment here. Hopefully this clears up and you all stay safe. As a reminder, we love doing the mailbag segments with you. We're going to do another one tomorrow on the show. So if you have any questions on technical analysis, on charts, on particular tickers, on anything that we're showing on the show, no question is out of bounds. Just send it to us via email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv. Or if you're watching our video on a place like YouTube, just put a comment below the video. We review all of that, and we'll answer some of those questions on the air tomorrow. Our last segment today is called Shifting Stocks. So now we've talked about the big picture macro, looking at this pullback in the broad indexes. We've talked about sectors, the emergence of industrials and materials, the potential weakness in technology and guideposts there, and consumer discretionary continuing to run. Let's go to our next segment, Shifting Stocks. Here we're going to focus on particular names. We do this a couple different ways. What I wanted to do today was just focus on some of the top ranked names according to our scooter rankings. So SCTR is the StockCharts technical ranking. If you look at our chart school articles, we'll explain the methodology and what we use, but I think of it as a simplistic but very powerful, robust trend following model, and you essentially dump in a universe. So we're looking at large cap stocks, but we can look at other universes as well and relate all of those charts to one another. So instead of looking at 1,000 charts and trying to make sense of how they relate, you can look at one number and at least get a sense of what's working and what isn't. There's a lot of benefit to that. We went through the scooter rankings in a level up segment last week. I think it was on Thursday or Friday, Thursday, I want to say maybe. So if you look back on our YouTube channel, you can check that out. We explained a little more detail in terms of how you might want to use them. But let's jump into some of these names. So, there are a couple ways I like to use these scooter reports, and you can find them by clicking on charts and tools and then click on scooter reports. We're going to look at the large cap stock universe. We're looking intraday. So I'm just looking, since yesterday's close, Friday's close, where are we at right now? These update during the day, and what you'll see is if what sector is most represented on the top of the fold, page one. By far, it's consumer discretionary. And it's not just one type of stock. It's not just one group at the top here. If you look at the industry column, we can see Tesla, which has been the #1 ranked name, even with its pullback, and it's up pretty good today here. I didn't see where it closed. Let's see, up another 12.5%. You think about the market and what you may be looking for if you want to be optimistic about further upside. I'd want to see a Tesla-like pattern on the S&P. The S&P is kind of down here right now. You can see Tesla is arguably rotating back to the upside with an RSI pulled back to around 40. That's sort of classic bull market pullback type of pattern. One of two things happens. We continue on to 500 and beyond as Tesla continues, and this is the ultimate viable pullback after a huge run. Or if and when we would start failing down through this swing load, failing down through the 50-day moving average, which is already almost 100 points away, granted, but that's what you get when you're looking at a stock like Tesla right now. That would suggest to me that this was the beginning and there's further downside. Sort of right at that pullback level, but today's action certainly more constructive than not. So you have Tesla at the top of the list. L Brands, LB is the second chart in there. And again, what's consistent about a lot of these stocks is they've had nice breakouts from highs earlier in the year. They've pulled back a bit in the last week or two, as pretty much everything has, but starting to be, again, if you didn't know anything else and you just looked at this chart, the trend overall has remained relatively positive, and they're sort of in that bullish pullback kind of mode. I wouldn't be surprised even if the broad market sells off, and I think that's what we might see. I think you might see the S&P go further down. I think you see some technology stocks struggling potentially, but there are going to be names that continue on to new highs and do just fine. And I think if you think like a stock picker right now, you're going to be pretty well suited regardless of what happens. After that, you get into industrials with FedEx, you get Freeport-McMoRan, FCX #4. We have our first technology name, NVIDIA, which is in one of the semiconductor stocks, and then the next 5 to round out the top 10 are all within consumer discretionary, and it's home improvement, retail, it's home construction, the home builders, it's a cruise line, it's a clothing line. I mean, it's a mix of things that are all represented up here. But, it's noteworthy that over half of the top 15 to 20 are all within consumer discretionary. And that's really why the relative performance of consumer discretionary, especially on an equal weighted basis, looks pretty good relative to a number of other sectors right now. We looked at Tesla, we looked at L Brands. Let's continue on. So when we think about charts that have held up pretty well and are doing nicely, so a stock like FedEx is actually making new price highs, a new 52-week high today. And there are not many stocks in that bucket right about now because so many pulled back in the last couple weeks and sort of had this rotation lower, pulling back to potential support levels. FedEx has actually continued, for the most part, unabated to the upside. And you see a nice swing into the close on Friday, closing down below the open today, but overall still in decent shape for sure. And the relative strength is what really tells the story. Since mid-May, that's almost 4 months of solid relative outperformance from FDX. The next one's FCX, Freeport-McMoRan. This is the first material stock that's on here. And again, what's interesting is if I showed you this chart and covered up the ticker and covered up the sector and asked you what sector it represented, I doubt you would probably say materials as one of your first couple guesses, unless you really looked at the charts very intimately. Some of my former analysts at Fidelity would know charts flat, and I can do that with some mega cap names, but they would know mid-cap stocks in a sector that I would have no hope of ever remembering. They could do it on site based on the pattern. So we're not at that level, but I think looking at this, it looks like a tech stock. It looks like a consumer name. Does not look like a material stock. But this is what FCX has done. And look at the relative performance, which has been nice and positive. So one of the benefits of starting with this sort of list and just sorting on the strongest patterns, and then going through the charts, you might be surprised by some of the sectors that are represented. The other thing that jumps off the page at me is out of the top 20 stocks, there are 1, 2, Salesforce might be number 20, right? If you look, there are 2 out of the top 20 in technology. And for a sector that's gotten us here, that's pretty remarkable how tech has rotated down below the fold. Also, communication services, one of those stocks, Viacom, CBS here in the top 20, but other than that, not much. So, again, sector-wise, it's really been consumer that's overtaken the top 15, 20 stocks according to the Scooter rankings. Viacom, again, when I'm doing my weekend review of the S&P charts, VIAC popped on my list as I was looking at some of the individual names. This is one that, if you think of the classic breakout, base breakout, right? You hit the peak in June, you came off, you rotate above the 200-day, you finally get above that June peak. This is at a time right here when the market's pulled back and people are questioning whether this is going to go a bit lower. Viacom will have none of it. It's just continuing to the upside. So I think it's interesting to focus on some of these stocks that have been relatively immune to the pullback of the last couple of weeks, holding up pretty strongly. And I think this, the top of the Scooter rankings list can be pretty helpful. We have to wrap the show, but I would point out my next step after what I just did was to sort this by stocks that have lost the most in their Scooter ranking today and stocks that have gained the most. And that's usually if you think about the top scooter ranks, if stocks at the top of this list ideally would be ones you already know about. You shouldn't be surprised that something's on the top because you've seen the charts emerge. The way you find them before they pop up here is you look for stocks that have been beaten down and have started to improve a little bit. Interesting to see some hotels and others on that list. Let's wrap the show and go right to the 3 and 3 charts. 3 minutes. Here we go. We'll do one from each of the 3 methodologies: top down, sectors, and bottom up. So starting at the top down macro, we'll look at the chart of the dollar. And again, I think people love to oversimplify. There's a narrative. There's such a beautiful narrative you can paint with the dollar has been weak, which means XYZ has happened. If the dollar strengthens from here, that means all these different things should happen. And again, you are basing that on historical reference, which I get, but I would caution you to make bets based on should happening. Don't should on it, but instead focus on what could happen and focus on the probabilistic outcomes. If that's, if a strong dollar from here would mean U.S. stocks should outperform international and small cap stocks should outperform large cap, fine, but focus on the prices themselves and see what's actually happening. But what jumps out on the chart of the dollar is lower lows in price, higher lows in the RSI, a bullish divergence, which speaks to or suggests the fact that the downturn in the dollar may be over for now. Chart number 2, thinking about sectors, is really looking at the XLK. Again, I don't buy the idea that the XLK can go down a bunch from here and everything's just going to be fine. I think there's a lot of exposure to mega cap tech and that theme of the persistent outperformance of technology and related stocks within there. I think if you see things break, I don't think people are going to magically rotate into Caterpillar and feel great about it. I think they're going to feel like things are getting worse because the big high-flying names that have gotten us here are starting to struggle. So I think XLK relative to its 50-day and this relative performance line are 2 really important things to watch this week. Finally, I would focus on stocks that are working. The Scooter rankings are a great way to do that, but some process you have to gear into, to lean into what's working and lean away what isn't. If you think like a stock picker, there are charts like FCX, like FedEx, like many others that are Viacom, CBS that are breaking out, that are in strong uptrends, that aren't feeling a lot of pain, and those are the ones that I think you want to be focused on. Folks, that's our show for today. Thank you so much for joining us. every weekday for the Final Bar. We have some great guests lined up this week. If you missed any last week, check out our YouTube channel for all of our previous shows. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.